Hi there. In this video, you'll discover when life insurance forms part of your estate and how trusts may reduce inheritance tax exposure.
Did you know this simple, everyday paperwork mistake is literally costing UK families tens of thousands of pounds in completely avoidable taxes every single week? It's true. Hello and welcome to this My Tax Accountant Explainer. I'm your host, and as a UK tax expert here at MTA, I see hardworking entrepreneurs and families make this exact same, frankly, devastating mistake all the time. So today we're exploring a really vital question. Is your life insurance policy taxable? And, much more importantly, how can placing it in trust save your family an absolute fortune?
40%. I mean, that is just a staggering figure, isn't it? A shocking 40% of your entire life insurance payout could be seized by HMRC if you fall into a very common inheritance tax trap. Just think about the emotional sting of that for a second. You diligently pay your premiums for decades, you make sacrifices to protect your loved ones, only to have nearly half of that money swallowed up by the taxman on the exact day they need it most. It's heartbreaking. But here's the good news, it really doesn't have to be this way at all.
So here is what we're going to cover today to make sure you're protected. We'll look at the 40% tax trap, a real-life case study of an £80,000 mistake, how trust funds are the solution, the trust types and rules, your compliance steps, and finally, securing your family's future. Section 1, the 40% tax trap. Let's start by identifying the core vulnerabilities surrounding life insurance and UK inheritance tax. You see, a lot of people mistakenly assume life insurance is completely tax-free. And while it is true that the payout is exempt from income tax and capital gains tax, there is a massive catch. In the eyes of HMRC, your estate is quite literally everything you own when you die. Unless it's structured correctly from a legal standpoint, that massive cash lump sum from your insurance is automatically dumped straight into your legal estate, right alongside your property, your savings, your car, and your investments. Let's picture a typical estate valued at £900,000. So you've got a £550,000 family property, you've got £150,000 in savings, and a £200,000 life insurance payout that wasn't placed in trust. Currently, the standard nil rate band in the UK, which is basically the amount you can pass on completely tax-free, is £325,000. Now, even if you factor in the residence nil rate band, which can bump a single person's allowance up to £500,000 if they leave a home to their direct descendants, this particular estate is still way over the limit. Anything above that £500,000 threshold faces a massive 40% inheritance tax charge. The insurance payout itself is quite literally the asset that pushes the estate over the edge and into heavily taxable territory. Section 2, Case Study, the £80,000 mistake. To see exactly how this catches people out, let's look at a highly realistic scenario. Take a self-employed UK contractor. This is exactly the type of hardworking client we assist at My Tax Accountant every single day. He's worked tirelessly to build a £550,000 family home to leave to his kids. He's built up £150,000 in business and personal savings, and very responsibly, he took out a £200,000 level term life policy. He took this policy out years ago to cover the mortgage and provide for his family if the worst were to happen. But, like so many well-intentioned people, he held it in his own name. There was no trust attached. When we actually crunch the numbers, the impact is pretty severe. Without a trust, his total estate is £900,000. Minus his £500,000 in tax-free allowances, his taxable estate sits at exactly £400,000. Multiply that £400,000 by 40%, and his grieving family is immediately hit with a £160,000 inheritance tax bill. Now consider the exact same scenario but done right. If that £200,000 policy is written in trust, the proceeds never enter the estate in the first place. The taxable estate drops down to £200,000, which effectively halves the tax bill to £80,000.
The outcome is just profound. Simply by completing a trust form from the outset, which, by the way, usually costs absolutely nothing and takes mere minutes to fill out, the payout legally bypasses the estate entirely. He hasn't reduced the value of what his family receives, he has simply kept £200,000 completely out of HMRC's 40% charge, saving his family a life-changing £80,000. It is, quite frankly, the easiest money you will ever save. Section 3, the solution, trust funds. So how exactly does this legal mechanism work to protect your wealth? I want you to think of it like putting a legal ring fence around your policy. By writing your policy in trust, you are transferring the legal ownership to chosen trustees. And because you effectively give up ownership, HMRC cannot class it as part of your estate. Your trustees simply hold it in a protective bubble on behalf of your beneficiaries. When you pass away, the legal ownership dictates that the payout goes directly to those beneficiaries, circumventing that whole HMRC estate calculation completely. And here is a massive professional insight for you. Did you know that trust-held policy payouts bypass probate delays entirely? This is absolutely huge. Probate in the UK is notoriously slow and painful. Aside from the immense tax savings, this structure ensures your loved ones aren't left waiting an agonizing 3 to 12 months for probate to clear when they urgently need cash. Trying to pay for a funeral, clear the mortgage, or just manage everyday household bills while assets are frozen is devastating. With a trust, they get the funds in a matter of weeks. Section 4, trust types and rules. Because obviously, you've got to choose the right structure for your family's specific circumstances. Generally, you're going to encounter two main types. An absolute or bare trust fixes the beneficiaries forever. It's incredibly rigid. So if you name your 2 children, you cannot change it later if you have a 3rd child. A discretionary trust, on the other hand, gives your trustees the flexibility to decide who gets what and when, from a broad list of potential beneficiaries that you provide. This is fantastic because it adapts to changing family needs. You know, like a divorce, a new grandchild, or perhaps a beneficiary who is simply too young or financially irresponsible at 18 to handle a massive lump sum all at once. Discretionary trusts give you that future-proof peace of mind. Now, please pay close attention to this because it's a huge professional tip. Beware the gift with reservation of benefit trap. I know it's a highly specific piece of jargon, but it is a crucial piece of advice from us at MTA. You must never list yourself as a beneficiary of your own life insurance trust. Sometimes people do this just in case, but if you do, HMRC will argue you retained a benefit from the trust, and they will drag the entire payout right back into your taxable estate. You literally have to exclude yourself entirely to make it work. Section 5, compliance steps and upcoming changes. Getting the paperwork right here is absolutely vital, especially with HMRC's strict rules. The compliance steps are actually quite straightforward, but they have to be executed properly. First, choose your trust type, usually a discretionary trust for most families. Second, appoint at least 2 trusted individuals as your trustees. Third, complete the trust deed alongside your life insurance application. And fourth, you have to be incredibly careful regarding HMRC's Trust Registration Service, or TRS. HMRC does not mess around when it comes to the TRS. While many life insurance trusts are excluded during your lifetime, if the trust triggers a tax liability or the arrangement changes, you have a strict 90-day window to register it. Missing this can result in immediate and, frankly, severe fines.
Timing is quite literally everything here. Setting up the trust at the policy's outset is ideal. Because a brand new policy has no open market value, transferring it into trust is usually a nil value transfer. So no immediate tax. But if you try to transfer an existing life policy into a trust years later, well, that constitutes what is known as a chargeable lifetime transfer. If the policy has acquired an intrinsic open market value, say for example your health has heavily declined since you took it out, it might trigger an immediate 20% inheritance tax charge just for moving it into the trust.
Furthermore, there is a massive legislative shockwave on the horizon. From April 2027, unused pension funds and most death benefits paid from pensions are due to be brought firmly within the scope of inheritance tax. Now, if your entire estate planning strategy relied on your pensions sitting safely outside your taxable estate, this is a massive wake-up call. Placing your life insurance in trust will very soon be one of the very few ways left to legally shield significant assets from the taxman. Finally, Section 6, securing your family's future. Let's recap what we've covered today and look at your next steps. So, just to recap the key takeaways. Life insurance in your own name is highly vulnerable to a 40% tax trap because it will automatically be added to your estate. Proper trust planning bypasses this entirely, securing the full payout for your family. Trust payouts completely avoid those agonizing 3 to 12-month probate delays. Discretionary trusts offer you the vital flexibility your family might need decades down the line. And finally, you absolutely must ensure you avoid the gift with reservation trap by never ever making yourself a beneficiary. Now, before we wrap up, a quick disclaimer. Please note that this explainer is provided for educational purposes only and does not constitute formal tax or legal advice. Individual circumstances vary greatly, and UK tax rules and allowances are always subject to change. So always seek professional, tailored advice for your specific situation before making financial decisions. I want to leave you with this really provocative question. If the worst were to happen tomorrow,
Is the taxman currently set to be the biggest single beneficiary of your life's hard work? Or are you ready to take control and actually protect your family's wealth? If you are at all unsure if your policies are in trust or if you just need expert help navigating these really complex rules, contact My Tax Accountant today. You can reach us by phone on 0208-570-8531. You can email us at info@mytaxaccountant.co.uk or just visit our website at www.mytaxaccountant.co.uk. Our team of experts is ready to help you structure your assets correctly. And please don't forget to subscribe to the MTA YouTube channel for more essential money-saving tax strategies. Remember, you spent your whole life building your wealth. Spend 10 minutes today making sure your family actually gets to keep it. Thank you so much for joining me, and I'll see you in the next explainer.